Welcome back to another episode of Hard Money Dispatch, the show that demystifies sound money and helps you see the system for what it is. Today, we're going to be talking about the ceasefire between Iran, Israel, and the U.S., how that sent markets soaring briefly, but now looks a little more uncertain. Google's latest quantum computing research paper and the potential advancements seen there. And signs of a Bitcoin bottom. Again, been talking about that for a while, but a new one just emerged. So stay tuned, and we'll get into the details of these things. First, the too long, didn't read type of summary is the U.S.-Iran ceasefire sparked a broad market rally, but cracks started appearing in as little as 48 hours as Israel launched its largest strikes on Lebanon since the war began, killing over 250 people and threatening to unravel the entire deal potentially. Bitcoin rallied to about 73,000 on the ceasefire news, which triggered 600 million in short liquidations. And the price is held above 70,000 despite the continued uncertainty. And an interesting point to note is that one of the things I've been seeing constantly in my social media feeds the last few days is that Iran is accepting Bitcoin as payment for oil tankers to pass through the Strait of Hormuz. I think it's a rate of $1 per oil barrel. So, yeah, that's creating some demand for Bitcoin, I imagine. Google's latest quantum computing research paper reduced the estimated qubit threshold for breaking Bitcoin's encryption by about 20x, but no machine capable of executing that attack exists, and Bitcoin's already preparing for this with BIP 360. The weekly MACD, which is a tactical indicator, is nearing its first bullish crossover since May of 2025. Sentiment has been at extreme fear levels for a record length of time, and Cathie Wood says the era of 85% drawdowns is over. Also going to mention last week's podcast briefly with Kevin Bell of Catena Bitcoin, which is a non-custodial Bitcoin lending platform registered in El Salvador. And all of this is coming to you from the latest edition of the Hard Money Dispatch newsletter. Go ahead and subscribe if you're not already. It's free, and I will leave a link in the description. So on Tuesday evening, President Trump announced a 2-week ceasefire with Iran via Truth Social. Markets reacted immediately. I remember I saw this news right after it broke, and the way I found out really was I went to check CNBC and saw that Dow futures were up over 1,000, and went to check the headlines, and sure enough, it was because of the ceasefire. And oil had also fallen to 95 per barrel. That's crude prices. I don't know about Brent. I know Brent oil had gone even higher. So it's a good sign, oil being down beneath the 100 barrel. In my opinion, if oil were to stay near 110, 120 a barrel for a number of months, that would bring vast, untold economic pain to the entire world, most likely. Even being at 90, 95 is dangerous, but things would really break if it was 110, 120 a barrel. And the last time we've seen prices in this range for any extended length of time was the 2008 financial crisis, right around then. The reason oil is a bigger deal than other commodities is that everything is tied to oil because you have to move things. You have to move goods around, and that takes energy, and the root of that is the price of oil. So trucks delivering things to stores costs more. Planes shipping things costs more. Shipping cargo ships, those become more expensive to run. So the list goes on. So that's why it's bad for oil to be this high, and that's why inflation is ticking up. I think I saw a headline of 11% inflation in March, so that's really bad, and it's only going to continue if oil stays that high. So I'm not going to go into detail about the whole ceasefire thing and everything that's happened. You can read that in the newsletter if you're interested, but basically the big takeaway is this all seems uncertain now because Israel started bombing Lebanon, and Iran said they don't like that, but Israel said, hey, the truce didn't include Lebanon. So, yeah, it's really a weird situation. We'll see what happens with it in the next few weeks. Moving on to Google's recent quantum paper. It's called Securing Elliptic Curve Cryptocurrencies Against Quantum Vulnerabilities, co-authored with researchers from the Ethereum Foundation and Stanford. And the big finding was that breaking the elliptic curve cryptography that protects Bitcoin wallets, known as ECDSA, will require far more resources than previously estimated. And the paper presents implementations of Shor's algorithm that need 1,200 to 1,400 logical qubits and 70 to 90 million operations to crack a public key. When translated to physical hardware, that comes out to about 500,000 physical qubits, roughly 20x reduction from the previous estimate of about 10 million. Now, that is a big deal, and this is a little more serious than the quantum fear-mongering I've covered in the past, where altcoin founders and conference speakers with obvious financial incentives are just hyping the threat to sell their own tokens or pump quantum stocks or whatever. But at the same time, no quantum computer, no functioning quantum computer capable of executing this attack exists, and probably won't for quite a while. And today's quantums operate in the range of few hundred to the low thousand noisy physical qubits with error rates that are way too high for the kind of sustained fault-tolerant computation that this paper describes that would be necessary to crack ECDSA and pose a threat to Bitcoin and cryptography. Which, by the way, as we've mentioned before here, episode with Greg McKeska earlier this year, it's not as simple as just cracking a public key, because there's more to it than that. The public key is not a direct representation of the private key. And so not just that, but the other cryptocurrencies, the altcoins, are far more vulnerable to this type of attack than Bitcoin is, because they reuse public addresses constantly. Whereas with Bitcoin, the only way you're exposed, well, with all cryptocurrencies, the only way your wallet's vulnerable to that attack is if your public keys have been exposed through you sending a transaction out of that wallet, rather. So Google set itself a target of 2029 for migrating to post-quantum cryptography, and that's Google's own internal deadline for protecting their systems, not a prediction of when attacks become possible. And that's important because people see that, oh no, Google's saying they got to switch by 2029. That means that that's the date. Like, that's when it's going to happen, and there's no hope if you're not prepared before that. Well, that's not necessarily the case, right? They're trying to be as conservative and well prepared beforehand, as proactive as they can. So they want to be ready by 2029. The threat might not come for 5, 10, 20 years after that. We don't know yet. But this is all theoretical, really, right? This is just an academic research type of paper. It's not some breakthrough in the technology itself. It's more discovering that the technology could possibly work a little differently than was expected. It could be more efficient. Also, I don't know if this was mentioned in this paper or not, but there's also the idea that AI could actually help accelerate quantum progress as well as progress in other technologies. Quick side note, another big news story lately has been that Anthropic created a model called Mythos that's so powerful they refused to release it to the public because it found thousands of zero-day exploits, which are vulnerabilities in browsers and operating systems that have not been patched, that could be exploited today. Now, last section, is the bottom in? I'm not going to make a definitive call here. No one can. But there are some more signals emerging, as there has been for a number of weeks now, as I've covered previously. One I saw recently from Mike Trading on LinkedIn is that the MACD, which is a commonly used technical analysis indicator, it's approaching its first bullish golden cross since May of 2025. And for some context here, the last time that crossover occurred, Bitcoin climbed from 94,000 to 119,000 over the following 2 months, leading to a new all-time high. And Galaxy Trading has noted that in both the 2018 and 22 bear markets, so the last two cycles, it took about 245 days for the weekly MACD to turn positive. And in 2026, we reached 245 days by the end of April. So this could be happening even sooner than in previous cycles, which is a positive sign. Bitcoin also reclaimed the 200-week exponential moving average on a weekly basis, a level that has historically acted as generational support during bear markets. Keep in mind, that's the exponential moving average. The simple moving average has not been breached so far this cycle. Extreme fear has also gone on for a record stretch. Since late February, it reached its highest level, and it's spent an unusually prolonged stretch in extreme fear territory, even going beneath times like the FTX crash or the COVID crash. The last time sentiment looked like this on the daily was February 7th, 2026, and the last time it hit extreme greed was October 5th, 2025. And Cathie Wood made an argument on April 1st on CNBC's Squawk Box, saying that Bitcoin's era of 85% to 95% drawdowns is over. And I tend to agree with that. A lot of people predicted that. And it seemed like that is what's happening so far. If historical patterns hold up, then we have 6 to 7 months left of a bear market, and we'll see how steep that drawdown gets. Right now, prices are down roughly 40% from the peak, and that's a lot less severe than the 77% drop in 22, 84% in 2018, or 93% in 2014, 2015. Some counterpoints to that, though, that not everyone agrees. Bloomberg intelligence analyst Mike McGlone has warned that prices could trend towards 7-year lows. The bear flag pattern that appeared in January, which preceded a 25,000 drop, may be forming again. Keith Allen of Material Indicators noted that the current price action is almost identical to that prior bear flag, and some traders see February's wick below 60,000 as a level that will be revisited. I actually kind of agree with that it is possible another dip to 60,000 could happen. But if that does happen, and price bounces back from it, in my opinion, that would very well mark the bottom, because that would just reinforce the fact that that is support and that is the floor. And just to recap briefly, last week's guest was Kevin Bell, CFA, founder and CEO of Cadena Bitcoin, and that was an interesting conversation. Go check it out if you haven't heard it. Cadena allows people to borrow against their Bitcoin while maintaining full self-custody. So how it works basically is you create a wallet with them, and you keep the keys to that wallet while you borrow against it. And another really cool thing is there's no liquidation risk, so you never get liquidated. And that's going to do it for this episode of Hard Money Dispatch. If you found value here, please share this with someone you know who might be interested. Be sure to like and subscribe if you're watching on YouTube. And don't forget to leave a 5-star review on Spotify or Apple Podcasts. Really appreciate that. It really helps out the podcast because we're small and growing, but growing steadily. We've got a big lineup of guests over the next couple months. I think we're booked out until early June at this point. So about 6 weeks. There's going to be a guest just about every week. So stay tuned, and I'll see you next time.